everyone. Today, I had the opportunity to sit down with Dave Szybunka, Senior Portfolio Manager and Managing Director of the Energy Team at Canoe Financial. Dave gave us an overview today of what's happening within the energy sector on a global scale, developments that are happening in Canada, and how the current U.S. tariff threats are going to play out in the energy sector. It's a really interesting interview, and Dave has incredible insight, and I hope you enjoy watching. Okay. All right, Dave, thanks for joining us today. We appreciate you making the time. We've been avid supporters of your fund for the past few years now, and a lot of our clients have been holding your strategy. So I thought it'd be a great opportunity for my clients to get to know you and to hear about yourself and how you manage the funds and what you're seeing in the energy market. So it'd be great if you could give us a quick introduction about yourself, your background, and the team's background at Canoe.
Yeah. So, I started my career in 2007. And so, when I look at myself, I started at a boutique here in Calgary called Peters and Company. Started on the research side, joined Canoe in 2011. Canoe was just getting going then. We had $20 million of energy assets. Today we are $1.5 to $2 billion of energy assets. But I started as an analyst here at Canoe. And you fast forward to today, and I'm the portfolio manager on all three of our energy mandates here at the firm. Canoe, as everyone knows on this call, has gotten a lot bigger. We're 20 billion of assets, round numbers, as a firm. We have internal managers, external managers. But yeah, my bread and butter is energy. And I would just say that when we look at our funds, it's kind of my background of we look at all things energy. We look at all these various subsectors of energy. Energy is not oil. Energy is oil and natural gas and alternative energy and refining and global LNG and all these various buckets. And so we're constantly looking at where should our chips be within the energy sector as we have a multi-year thematic on our views. But my background is tied to all these various segments of energy. We're not just a intermediate junior oil and gas fund, if you will. We look at a lot of different things within there. And then when I just broaden out our team, you have Nick Sokol on the trading side. He's a trader analyst within us. Courtney McKean helps us out a lot as it relates to just marketing presentations, making sure our clients are up the curve in terms of what they're seeing. And so, yeah, we look at all things energy at Canoe, and we look at global energy. It's not just a Western Canadian gas or oil and gas fund.
Great. That's awesome. So if I date back to what happened in COVID in 2020 and how everyone thought the world was pretty much coming to the end and there's going to be no need for oil and energy at that point, it's quite a stark contrast to what's happened in the energy markets and within your funds and how well you guys have done. So I was hoping you can give us a background of what you've seen evolve in the markets in the past 5 years or so, and maybe compare that to what had happened in the energy markets in the prior 10 years and 20 years before that.
Yeah. This is really important for clients to understand, especially as we go through choppy periods, Trump, tariffs, all these things, oil prices volatile. It's important for people to understand the backdrop of the sector and the industry. And when you go through the prior bull market, I'll start there. You look at the prior bull market kind of from 2002, 3 all the way to 2014. Energy cycles take 10 to 15 years to go up, 10 to 15 years to go down, 10 to 15 up, 10 to 15 down. So they don't just start and stop and end and it's over and that type of stuff. So in that 2014 period, when you looked at what happened through that period in the last bull market, lots of capital coming into the space. Commodities and energy is where you want it to be. You saw that a lot of undisciplined things happen, lots of startups, everyone coming in, grow, spend. And it was just like as the cycle continued to move through that decade-long bull market, you watched more and more startups, lots of accelerations of capital, equity being raised, accelerate capital spending, no thought about profits and making money. And so when you go through the first part of the downturn from 2014 to call it 2020, a lot of it was to do with, well, we need to become profitable. We need to make sure that we can actually compete at a lower commodity price. So it was kind of like cleanup period as you're in the early stages of the bear market. And you fast forward to that coming out of COVID today, and you look at the sector, well, what's been happening? The biggest M&A cycle has played out in my career. Lots of mergers, lots of acquisitions, bigger and bigger companies forming, fewer and fewer companies controlling and owning more of the resource. And when that happens, you go from this undisciplined backdrop to a very disciplined backdrop. Fewer companies control more of the resource, and you now look at these big, large companies. And when the commodity prices go up under that scenario, they don't ramp capital spending like they used to. You look at back in that prior bull market, companies were on average spending 100% of their cash flow to grow. Well, today they're spending 40 to 60% of their cash flows to kind of maintain production and not really grow. And then they're having shareholder returns with dividends, buybacks. So you're staring at a very volatile oil price on your screen. You're watching oil, as we record this call, go from $72 here 2 days ago to 62. The stocks are coming in. But beneath that, as these companies' businesses, they look good. A lot of companies look really good as it relates to, okay, they're not spending 45% of their cash flow anymore. They're spending 55% of their cash flow. But there's not this, oh my God, there's too much debt. There's all this growth. We're undisciplined. We're ramping. There's all this money coming in. No, we're in an energy profitability super cycle where investors are hesitant. They're reluctant. They aren't coming in like they used to. And that is causing a lot more discipline beneath the surface on these companies. And they look structurally really good. Right. And that doesn't mean that you don't go through choppy periods, but when you extend the charts and lay out a multi-year thematic on energy and commodities, we believe that this is a blip within the bigger structural view because we think we're in year 4 of a 10 to 15-year energy cycle. It doesn't, you end a commodity cycle with a capital spending cycle. There's no capital spending today. There's dividends, buybacks, and anxiety. And so until we see more signs of a bigger investors embracing capital spending, which happens through price spikes and that type of stuff, that's the start of the end, but we're not seeing that today.
Okay, so can you just explain a bit more what that means? Like, what would trigger these companies to start on the capital spending? What would be the signal for some of these companies to shift their focus to that?
Yeah, so when you play out commodity cycles, like I said, we think we're in year 4 of a 10 to 15-year commodity or energy cycle. When you go through these earlier stages, and we just look at, to give you a feel, when I go to conferences in the first quarter of the year here and sit down in the room with these companies and they're presenting to a bunch of investors, the whole conversations is just shareholder returns, dividends, and buybacks. There's no investors going, you should be spending more. Well, the world keeps consuming more and more energy. I mean, a good thing for our clients to understand is investing in energy is a very investable theme. We've been growing our energy demand globally by 5 million barrels a day of energy equivalent each and every year. The world consumes 300 million barrels a day of energy equivalent today, right? And when we look at this growth of 5 million barrels a day of energy equivalent, we actually think we're inflecting to 6 to 9 million barrels a day of energy equivalent. So the world keeps using more energy. Forget about oil, but think about energy. The world is using more and more energy each and every day. But you look at these businesses, and investors are like, give me all the money back. Where's my dividends? Where's my buybacks? There's no thought of like, we should be spending more. So what happens through the cycle is because of that lack of investment, commodity prices go up over time. And then when commodity prices go up, the everyday consumer goes, who did this to me? Why are my bills higher? Why does it cost more to fill my car up? Why are the prices up across the board for commodities? Then when that happens, government policy starts to backtrack. As government policy starts to backtrack, there's a shift on like making it better to embrace the sector as opposed to coming at the sector, which we're starting to see signs of that, right? But you start to see shortages, price spikes, geopolitical risk, elevated geopolitical risk globally. A third war is breaking out. We haven't invested, price spikes start to happen. And when you put that all in a mixer, investors start to go, holy cow, we should be investing more. And that is where investors start to embrace the capital spending. Today, we're just too early in the stage of the cycle. So we're not seeing any of that push to invest more. But this is what will happen over time. And as that happens, the stocks are going to be way higher. The commodity prices are going to be way higher. You're going to turn on the television, CNBC, and it's going to be every 20 minutes someone's talking about energy again and how we should be investing more in commodities and energy, and you should have energy stocks in your portfolio. Like, that is not what we're seeing today. And so as we start to see that embracement by investors, that is getting to the second half of the cycle. Today, we still remain quite early in the earlier stages.
Okay. And it's interesting what you said is the demand for energy overall. One of the things that I noticed for an average investor is that when they hear energy, they think oil, purely crude oil. But with you guys, energy is obviously much broader, and you're in different types of the energy sector. So could you give a brief overview of how you shift through the energy and what you look at and what types of companies that you would classify as energy?
Yeah. So, I mean, we look at all things energy. So think of me as a pie allocator. I allocate the chips to whatever subsector within energy that I think we like our setup for. And so we can invest in transportation, midstream infrastructure, LNG, oil, refining, natural gas, alternative energy. Like, we can put the chips wherever we think is the best setup, and we don't invest over the coming 1 or 2 weeks. We invest over the coming 12 to 24 months, if you will. And so when we look at that backdrop, energy is a lot more, to your point, than just oil. When we look at our funds, a big call that we made last year was we structurally got worried about oil in the middle of the year. And so we went really underweight oil. Well, going underweight oil and overweight natural gas and power was the reason our funds were up roughly 25% last year, in a backdrop where a lot of oil companies and the oil price was flat to down, right? And so we really outperformed on that. What I would say is, as you think about our funds today, we are a little more balanced. I can't find an energy bull in the room. If I just laid out 2020, remember everyone experienced kind of inflation, and Russia invades Ukraine, and that was kind of euphoric in 2022. That was kind of people were optimistic on energy, as it had really been outperforming other sectors for the better part of 1 to 2 years. So investors went into 2023 bullish on energy. They went into energy bullish 2024 on energy. And now, as we're in 2025, I can't find an energy bull in the room. No one likes energy. Energy is one of the lowest weightings in the S&P 500 it's ever been at 3% as a weight. This doesn't mean it goes up tomorrow, but it means that where are people positioned in the market? It is not energy. And so I like that as a setup where I just go, no one likes my sector. People have been taking profits on my sector, and the stocks were way up here and now they're way down here. Well, the stocks are down 50 to 65% on a lot of these things if you were in the wrong areas of energy. So we have been building up select oil positions in our funds while no one really likes it. We've been riding our natural gas exposure. Some of these power names have come under pressure here a lot in the last little bit. So we built up positions in those, right? Global LNG guys have even come in a little bit here on the back of the broader market coming in. So we've built up more of a broad-based energy fund today. It's a lot more diverse than it was last year, where we were really hard on natural gas. Well, today we're a lot more spread out amongst the sector, because a lot of the sector has come in, and it's more about being positioned in the sector than a specific subsector within energy.
Okay, understood. So looking into 2025 and maybe 26, 27, what are some of the themes that you guys are looking at or concerned about, maybe regarding what's happening in the media today with Trump and the tariffs? Any developments on that are causing you guys to worry, or that are going to be opportunistic that you're getting excited about?
Yeah, so I mean, I would say a couple things. If you just said lay out what's been happening prior to the last couple days on just him coming out with aggressive tariffs. So what had been happening before that? Well, I haven't seen sector rotation in the market, aka selling one sector, tech or whatever, and buying energy. I could feel that rotation in 2021, 2022. Inflation running hot, rampant, other sectors down a lot, energy up a lot. I could feel money moving around. I haven't felt that in my sector for 2 years. There's been no sell this sector to buy energy. And so if you started to lay out the first quarter of the year, you start to see kind of pain happen in certain other places, broad-based commodities doing okay. Like this is not just an energy trade. This is a commodities trade. Commodities haven't been a fashionable place for investors to be for the better part of 10 years. So all of a sudden, gold's hitting all-time highs. Copper's coming in behind. Natural gas is going up. There's a broad-based commodity backdrop that's starting to do better. And this is putting pressure on other sectors in the market as inflation's kind of still relatively high at 3% or whatever. So we could start to feel this broad-based commodities doing better. When you lay out the last 2-3 days, it's just risk off. Trump tariffs bigger than people thought, global economies combating back and forth amongst each other. It's just a risk off, and everyone going from commodities are acting better to just get me out of everything. People are selling certain sectors, tech and all these things, but people are just selling energy stocks and commodities today. Everyone's just saying, I want out of everything. The correlations are going to 1. And so we're caught up in this too. You can feel it risk off within the market. But again, when I look at the fundamentals beneath these businesses, they actually look quite solid. Oil's gone from 72 to 62 in 2 trading sessions. Well, when you look at the businesses at $62 oil, they still look okay. You're going to get dividends, you're going to get buybacks, but there's going to be more of a differentiation amongst the companies, right? At $80 oil, all the energy companies look good. At $62 oil, well, some look good while others don't. And so we've positioned our funds up the quality curve within those companies where you are going to get good, solid shareholder returns. They are going to continue to pay you to kind of ride this out. But I would just say everyone's going to recession mode here. Everyone's going to, oh my God, we're going to a recession. People need to remember a few things on energy and oil within recessions. Just because you have a recession doesn't mean oil demand goes down. Oil demand goes down in periods like COVID or 1982, where unemployment rates go way up. When unemployment rates go to 17% like 1982, after a multi-year capital spending cycle in energy, it takes 10 to 20 years to get out of that, right? Here, we haven't had a capital spending cycle, and people are getting worried about a recession. Well, when you get a stock market recession like 2001, 2002, on the tech bubble of then, oil demand went up. So it doesn't mean that oil prices don't trade off, but they just don't stay down there that long because global oil demand actually kind of holds in. In the handful of recessions since 1950, when you look at the recessions where you didn't have these big, massive unemployment moves, 2 of them oil demand went up, 2 of them oil demand went down slightly. So all of that to say is, don't get all kind of caught up into a recession means oil prices need to crash and plummet and go to zero and no one's consuming oil anymore. That's not what happens. A stock market recession is different than an economic recession. So that's an important differentiator when you're going through a volatile oil price backdrop, right? And that can shift and change over time. But again, when I look at kind of the last little bit here, people are getting caught up in recession. Well, our base case has been a little bit more of stagflation, where you see global growth slowing on the back of these tariffs, but the global economies are starting from pretty healthy points. And when you play through stagflationary backdrops, you want to own commodities and energy. It's actually a really good performing sector as the market gets whipsawed. Oh my God, we're going into a recession, but it's just not that good of growth with still relatively high inflation. And if that's the backdrop for these choppy periods, commodities are a good protection vehicle within that backdrop.
Okay, very interesting. Another theme that we keep hearing about is the development in artificial intelligence and the amount of power that is required for these data centers to utilize AI. So do you have any comments on what's going to be happening within that specific sector, how some of the energy sectors that you look at are going to be utilized for this artificial intelligence wave?
Yeah, that's a good point. So, look, to kind of walk people through some facts, electricity demand in the US has been flat for 10 to 15 years. Okay, it hasn't really moved as people are kind of consuming more of it on a personal basis. There have been efficiencies on that as it relates to just think about light bulbs and kind of LEDs and stuff like that. It's like, well, they consume 80% less energy than they did 20 years ago, right? So electricity demand's been flat. Then you enter the stage of energy demand tied to AI. And this is really relevant because when we look at what's been happening on the tech side of things, we're in an arms race globally as it relates to big tech and AI. And you are seeing investors embrace a capital spending cycle in big tech, right? When you go like, what's the start of the end of a commodity cycle? When you start to see the companies spending more and investors embracing it. Well, what ends any cyclical asset cycle is a capital spending cycle. And we're seeing that embracement by investors in big tech today. Well, of course, we should be spending more. We got to keep ahead of China and compete against China. You're seeing billions of dollars of capital spending happen on this AI thematic. So that's the start of the end. It doesn't mean it's over for that sector, but you're going to look back on a lot of capital getting spent and not a lot of returns. But as it relates to energy demand, this is a big inflection. There's a lot of power consumption by big tech that's going to happen at a time that the grid is 40 to 50 years old in the US. You haven't invested in any of this. And now you got these big tech companies going like, I need to source more of this power. It's going to have implications for the consumer, where big tech comes in and all of a sudden they're getting the power and not the everyday consumer. This ties back to my government policy, starts to backtrack going, man, I need to get the costs down for these consumers or I won't get reelected. So this is all on the forefront. And when you try and put into perspective this inflection of demand on power consumption, it's a big deal. When you just look at the globe today on energy demand tied to AI, if you're starting from zero today in 2025 and you look out to 2030, by 2030, you're a top 10 country in the globe consuming power from zero today. This is massive amounts of energy, right? And this will have implications. How are you going to get that power? Well, when you think about demand on energy demand tied to AI, think of it like your computer. You need 99.9999% reliability. Your computer can't go on and off and on and off, and it doesn't work. You can't have wind and solar on that. You need base load power, which is natural gas and uranium, right? Coal is still a good factor on that, but the world, as we all know, is moving away from coal or trying to use less coal within the backdrop. So we really like the setup for natural gas on the back of this because we see a multi-year thematic of just we were already using more and more natural gas. Never mind now this power inflection where these big tech companies are going to need more base load power. Uranium is a thing, but the market's pricing that narrative like we're going to get uranium tomorrow. On average, it takes 8 to 10 years to build a uranium nuclear facility for power. If you just had it everything was ready to go, your approvals and everything were in place and you started building today, it takes 8 to 10 years. So this will come to fruition in the 2030s, but these big tech companies need the power today. And so there's a big void of natural gas that we think is going to be relevant. And remember what I said kind of 15 minutes ago, well, lots of mergers and acquisitions have been happening. So now today, when you look at who controls the gas molecule, lots of big companies that control the resource, not lots of hundreds of small companies that see a gas price go up and ramp spending again. It's the big motherships that control the resource. So we've watched the gas prices go up here in the last 2-3 months, and the big companies are like, okay, cool, I'm going to make more money. There's not this reaction to price like it used to be back in the prior cycles. But all of this in the mixer is we're going to need more energy. We're going to need more gas. We're going to need more power, all these different sources.
That's really fascinating. And so to wrap it up, I was hoping we could just talk about the Canadian market. And I know we're so blessed to have incredible natural resources, oil and natural gas. So if we can end off just discussing how what you see happening in the Canadian market and what it would really mean for Canada as a country if we're able to actually get our energy to different markets, get it out of the country, and maybe tone back our reliance on the United States, which we're hearing a lot about in the news right now. So hoping to get your thoughts on that.
So let's conclude by starting at a 50,000 foot level. At a 50,000 foot level, the world has had cheap energy for the last 30, 40 years. It's been low geopolitical risk on average with an abundance of resource and everyone holding hands and getting along. Does it feel like that today? The answer is no. And we think we've already shifted to a higher geopolitical regime with more geopolitical risk, countries dividing. It's about me taking care of my people, you taking care of your people. Countries with lots of resource, Russia, Iran, team up with countries with lots of people, China. This is starting and happening already. And this age of everyone getting along, holding hands with low costs for consumers, we think it's over. And when we think about these inflections that happen over multiple years, we think you're going to fast forward the clock in the coming years, and it's going to be a backdrop of high elevated geopolitical risk with higher costs for consumers. And the world's dividing. And when you put all that in a mixer and you play out the commodity cycle that I described earlier, you're going to want commodity energy exposure in our view. So it's been a deflationary backdrop with commodity prices and energy costs low for everyone. We think it's inflecting the other way. It's going to be the way you hedge your bills on your higher costs at the pump or your higher costs on natural gas or your NMAX bills or whatever is by owning some commodities and energy to offset that. And so we think that that's very relevant to think about because the world's divided and shifting already. And this is not a 1-2 year phenomenon. This is going to happen for the next 10, 20 years. This is the backdrop. So get over that. You're going to feel like, should I get on an airplane because I don't feel safe about flying to that country? That's what we had in like the 1970s period with the Soviets and all this. Like we've had like Democrats versus Republicans, liberals versus conservatives. We're going back to us versus the Soviets. That's our view. So as we go to that, you get elevated geopolitical risk, right? So this is relevant to Canada because we're long resource in a big way. And we think the world's going to call upon our resource, long life oil in the oil sands, long life natural gas in Northeast BC and Alberta, in the world of energy security. We think that, and the barrels are priced in the hole today. And when the world starts calling upon this, again, you're going to have a government that embraces it or they just won't be in power. And so this is relevant to Canada because we haven't had supportive energy policy in North America for the better part of a decade. And now you've watched a shift in the US here. Chris Wright from the US administration, who's the head of energy for Trump, he is a smart guy. And if you talk to Chris Wright, which we have on his energy policy, it is pro-America. We're going to have resource for Americans. And if we have excess resource, we're going to export it to the globe and make a bunch of money. But we are going to support this sector. And that's what you're competing against. Why can't I just take my dollars as a Canoe Energy Fund manager and just go south of the border? I can. So that is combated against, well, what is going to be the energy policy in Canada? This whole Trump narrative of I might tariff Canada, this is a wake-up call. And this could be the best thing that ever actually happened to Canada as investors then start to go, well, we should get more egress and build more pipelines and have more access to global markets. You're kind of feeling that right now, right? You were not feeling this 24 months ago. And so is there a big shift that's going to happen here? And the world calling on more Canadian energy and Canadians going, yeah, let's get diversified away from the US? This could be the best setup for Canadian energy we've ever had. This is a medium to long-term comment, and we will see how this looks as new governments get in or policies come in on Canada. But it's a very interesting setup at a time that investors are really underweight energy, period. No one owns it. And all of a sudden you could have a thematic shift on, I need more commodities and I need more Canada because we have a lot of resource and are getting supported now. These are all inflections that aren't here today, but I, as an energy guy, can see how this flips over time. And this will be the generalist buying energy stocks up 50, 60, 70% from here, because he's just going to be going, well, the world keeps using more energy and we keep using more as investors, and there's energy demand tied to AI, and this Canada resource looks pretty interesting. And all of a sudden there's M&A and a global guy comes in and buys a big gas guy in Canada, and the narrative shifts. I say to my sales guys all the time, price drives sentiment. The higher they go, the more they like them. The same thing happens on these sell-offs that we're experiencing today. But when you look at a multi-year thematic view, there's a pretty interesting setup here for the sector.
That's incredible. It sounds very exciting, and hopefully it can go smoothly and be prosperous for Canada as a whole. So we're going to wrap it up there, Dave. That's it for the questions that we had. We really appreciate your time and your input. Very lucky to get on this call with you. So thank you so much. And as you know, we're proud supporters of your strategy, and we will continue to be so. So thanks again, and appreciate your time.
Yeah, thanks for taking the time for everyone.
Okay,
listening.
man.
Okay.
Awesome.